Moving away from stock-specific news items, let's talk about some other top news stories of the day, and one of that is the fact that the IRDA has come out with some recommendations and norms rather for listing or IPO norms of life insurance companies. But a little while later we had a chance to speak with Ajay Srinivasan. In fact, this is a recorded conversation with him, and Ajay Srinivasan is the Chief Executive of Financial Services of Aditya Birla Group. Let's speak to him. At least this was recorded earlier, but let's try and understand what he had to say. We asked him if he got a chance to read the guidelines and what he makes of it.
So we broadly welcome the final guidelines. I think the guidelines give the shareholders and companies several options to raise funds, either by way of a public issue or private placement or an offer for sale. I think the public issue norms seem quite stringent, but I think in a sense that's good because that will ensure a limited number of financially sound and established companies will access public markets and thus build investor confidence. At the same time, other companies who don't meet the public issue norms will still have the option to raise resources through private placement and other sources. So I think it gives both companies an option to raise that.
See, we also asked him whether or not he feels that these guidelines that have come in from the IRDA, including for the insurance companies to come out with, it's going to encourage these companies to come out with IPOs, and here's what he told us.
I think this is both a company-specific decision as well as an issue with the broader market. I think the guidelines give the flexibility to companies to go public as and when they're ready. But other factors like market conditions will obviously play a role. Investors in markets like ours will certainly look to see visible signs of growth momentum returning to the sector, and that's what will really drive interest in a sector like this.
IRDA has also said that it's going to decide by its own about the promoter locking and also about FII allocation. So we asked Ajay what his views are on that.
Yeah, my sense is that this is really an enabling provision from an IRDA perspective to ensure on one hand there's not an excess supply of paper in the market, on the other hand to ensure that the subscribers are long-term holders in an industry like this, and at the same time to ensure that adequate promoter involvement is created wherever the IRDA requires. So I see it as an enabling provision, and I don't see anything wrong with it.
Merits therefore to ask whether or not these norms will encourage more investment in the life insurance sector, and when we posed that question to Ajay Srinivasan, here's what he told us.
I think it depends on which kind of investment, if you're talking about public issue or not. I think from a public issue perspective, clearly the way the guidelines look, it looks like it will be fewer people who will be able to access the market given the conditions that have been prescribed. But there will be opportunity for other people to access through other sources. But as I said earlier, I think this is really going to depend on the visibility of growth momentum. That's what investors look for in industries like this. The multiples are really based on the growth of new business. And we'll have to see that momentum coming back before you can see this interest coming.
And then we posed the similar sort of questions to Ashwin Parekh of ENY. Hear out what he told us.
IRDA has really clarified that in keeping with the Actuarial Society of India, these guidelines will be followed wherever a company has embedded value more than twice the capital introduced. They would be eligible to list their equity to go to the markets. So that's a very good deviation. There's one clarification which is still sought and it's still missing, is the whole issue about 25% of equity to be offered to public, or if the second alternate method is under which, let's say, the price discovery happens through 50% of the stock offered to QIPs, that is to institutional purchasers. There once again the clarity in terms of what is that 25% going to do. I mean, is it really going to be applicable for life insurance companies? We're still looking for a clarity.
That aside, then let's take a short break here on Buy or Sell.